Good morning, everyone. I'm Vince Lansing. This is the Gold Fix Market Rundown. We will be discussing the silver market today from two perspectives. Let's start. 10-year yields are down 8. The dollar is up 37. The S&P 500 is up 113. The VIX is down 1. Gold is up $61 at 40.79 and change. Spot silver is 51.41, up a buck 28 above 51, which was a previous resistance area and where someone we believe was sitting on it is no longer sitting on it anymore. Copper 498, up 20 cents. WTI up $1.03. Natural gas down 5 cents, not correlated with oil. Bitcoin down 600 and change. Ethereum down 58. Bitcoin and Ethereum trade over the weekend, though. They're up. They're back up a little bit. Platinum, palladium, both very strong. Palladium up 32, platinum up 60, gold, silver, again, lower, below 80 now, and grains are mixed. Okay, there's the home page. Front and center, the limits of the milkshake theory. That is a comment on what makes, as robust as the concept of the milkshake theory is, it has a vulnerability. And not many people talk about the vulnerability. And so we do, and we lay out what the vulnerability is. And that vulnerability is the balance of payments in the globe, and the fact that if you're demanding that people pay you money back, they owe you in dollars, but you restrict the ability to them to earn the dollars, well, can they abrogate that debt? And the answer is eventually yes. Upper left-hand side, London squeeze, the silver war between East and West. Lots of other pieces there. Let's just get right to what we're talking about. We have two topics today. The first topic is silver squeeze. Planes headed to London to cover shortfall. This is a news item that came out over the weekend that we added some material to. London's century-old silver market is in turmoil. A powerful short squeeze has pushed benchmark silver past $50 an ounce, currently trading 51 and 36, just the second time ever. With liquidity evaporating, traders desperate for metal are paying sky-high borrowing costs. India's sudden surge in demand has worsened the squeeze, while London's vaults now hold just a fraction of their former inventory. As paper and physical markets collide, costly international shipments may be the only relief. That came out over the weekend, and we posted over the weekend. We emailed that this morning. So that's the news item if you're trying to catch up to what's causing this. We're not going to get into the granular stuff too much today. Before we get to the main topic, I'm going to go through the related post. The related post, limits of the milkshake theory. We just explained what that is. Hartnett, in a relatively brief report over the weekend, he discussed two concepts. One is that the gold market should continue rallying to as high, historically speaking, as $6,000. And he also talked about the credit cracks that he sees in the market. London squeezed. That's our opinion of what's going down. We view it as London as being in a sandwich between U.S. demand and China demand, and U.S. or China has to rescue them. And so far, no one really is yet. Founders, the AI bubble and gold debasement narratives. There are two narratives out there competing for people's money: buy gold because the dollar's going down, buy AI, or don't buy AI because of the bubble. Gold monthly, that's an ING report. And India halts silver ETF purchases due to shortage. India, I just make a comment that the India report is the point of a spear that we're seeing everywhere. Everyone that we've talked to and we've done the research is pointing to various coin dealers and product sellers restricting access to product. I chose those words carefully. In some instances, you're hearing them say, we're out of product. In other instances, you hear them say, we on the Perth Minute, it actually says technical problems. And in other instances, you hear them say, because of logistics issues, we're going to hold off on onboarding new clients. All of those things add up to a coordinated effort by global players to slow down demand, to let the supply in London catch up. That's what's going on. It's the same thing as raising margin requirements. When you raise margin requirements, you slow down demand. They're throttling demand to protect the London hub. That's my opinion. They're not all out of metal. I can get metal. They're all out of metal in the proper form, or they're not onboarding because premiums are too high. This is the world of the coalition of the willing working together. Okay, so editorial stuff aside, let's go to the thing I wanted to talk. This is the website of the LPMCL, the London Precious Metals Clearing Limited, as in limited risk. And on the front page, there are 4 banks on the right-hand side. Members of the LPMCL are HSBC, ICBC, JP Morgan, and UBS. They are the bullion banks of the bullion banks. So you have all the bullion banks that face the business, and you've got the 4 primary dealers. There used to be more. I think Deutsche Bank was one, but they're no longer here. What we are trying to do right now is give you the facts very simply so you can make your own conclusion of what is going on and how it is going on and why we are in the silver crisis that we are in. At the center of the global precious metals market sits the London Precious Metals Clearing Limited, or LPMCL. It is the operational hub through which the world's largest bullion banks settle and clear trades amongst themselves. This is an interbank dealing network, something that I'm familiar with, not a customer-facing market. The member banks currently are HSBC, JP Morgan, ICB Standard, and UBS. They transact bilaterally with each other only using credit lines and unallocated metal accounts to maintain liquidity across the system. These banks face inward towards the hub center when trading with one another and outward when servicing clients. So you can look at them as sitting in a chair, and they swivel inward to trade with each other, and they swivel outward to service largely captive clients. Their mutual dealings form the internal liquidity engine that enables the broader spot market to function. The system operates through netting and book entry transfers rather than physical bar movements, meaning the majority of activity exists as ledger adjustments within a closed consortium. To put a little finer point on it, one of the banks has captive clients. This is my client, and a client